Hello, everyone. Welcome to video 6 of chapter 5. In this chapter, we're talking about capital cost allowance CCA. Hopefully, by this point, you're comfortable doing the basic CCA calculation. We take our UCC, undepreciated capital cost, multiply our class rate. That generates our CCA, the amount we're allowed to deduct from income. That opening UCC minus the CCA taken is what UCC we're left with. In this video, we're going to start talking about dispositions. So I'm going to have this video where I'm going to try to talk you through, I guess, the rules or the concept of the disposition. And then in the next video, we'll do a handful of exercises. I don't think we're going to talk long about disposition, but I do think it can be a confusing topic. So please bear with me while I take this moment to try and talk you through what happens during a disposition. When we use the class system for assets for CCA, all the assets that are of the same type kind of go in this one bucket. So if we have class 8, which has a lot of furniture in it, every time we buy a desk or a chair or a couch, that just keeps getting added to the bucket. As they're in the bucket, over time, we're using those assets. They're aging, they're being degraded, they're being used by their functional purpose. So we put in that asset at cost, and then over time, we've used the value. So that CCA is supposed to represent the amount of value that's being used up and reducing our cost amount. So our capital cost is always important to note because that's what we originally put into the bucket. And the UCC is important to note because that's how much value is left in the bucket. Whenever we have a disposition, we tend to take the proceeds, the cash received for the sale of a depreciable property, and we simply subtract it from the UCC. So we put something in at cost, we used up some of its value. Let's say we put in 10,000, we used 4,000. So there's $6,000 left in the bucket. Someone pays us $3,000 to get it from us. We take that $3,000 and we subtract it from our UCC. So we got it here, we used some, and then we sold it. So CCA and proceeds of disposition subtract from our UCC. Now, why am I emphasizing this? From an accounting standpoint, getting rid of an asset is pretty straightforward. What was its carrying amount? Did we sell it for more? Capital gain. Did we sell it for less? Capital loss. But that doesn't work for a tax perspective because that difference between our original cost and where our UCC is sitting was 100% deducted through CCA, the tax version of amortization. So we used this space to remove our income 100%. When we have a capital gain, from a tax perspective, capital gains are added to income at half the rate. So if I sold something for $10,000 of capital gain, it's only adding back $5,000. So it creates this difference between the loss in value was subtracted 100%, but an add back, if we sold it for more than our UCC, that would be added back at half, 50%. So 100% deduction, but a 50% income isn't quite fair. So the CRA comes up with this alternative. Capital gains don't come into play until we sell something for more than its capital cost. Only the value above this amount is considered a capital gain. The difference between that original cost and where our UCC is sitting is recapture. We removed a certain amount of value, and then by selling it for more than its UCC, we've recovered some of that value. So we deducted too much. We didn't lose all this value. We took too much CCA. So we need to recapture that income. So recapture is any recovery of value between where our UCC sits and the original capital cost that we paid for it. So that is why we always subtract from UCC the smaller amount of proceeds and capital costs. In our bucket, we put something in at cost. We can't take out more than what we put in the bucket. So up to capital cost, from UCC to capital cost, we will recognize recapture using the lower amount of the disposition. Anything that's left from the disposition above will be capital gain. So in our bucket, we added something at $10,000. We used $4,000 of CCA, so we've dropped it. And then let's say it went up in value and we sold it for 12. So we bought it at 10, used 4,000, and then we ended up selling it for more than we paid for it. Well, those proceeds, we will subtract the difference of $10,000 from our bucket. So $10,000 gets subtracted from our UCC value. Our UCC value was 6. When we subtract $10,000, it becomes a negative number. So a negative number can never be in UCC. So we had 6 was our UCC. When we subtract 10, we have -4. We have to get the UCC back to 0. So that add back is recognizing the recapture. For us to subtract $10,000, that must mean we didn't actually lose the value of that CCA. So when we subtract that full amount, it creates a negative value. That's the difference between, which pretty much equates to our CCA taken. So we will add back the difference. Whenever UCC is negative, we have recapture because we have to add back income to get to 0. But we sold it for 12. We sold it for 2,000 above. So that $2,000 difference, that 12,000 minus the capital cost we removed, that $2,000 difference, that is capital gain. This is how dispositions of depreciable property can be complicated, because anytime we have a sale, we have to determine, is there recapture? Is there capital gain? In my original statement, I said we put it in for 10, we used 4,000, we're sitting at 6. When we sold it, we only sold it for 3. It's a value. Our UCC said the value remaining was 6, but the value of it was only 3,000. That's what we got for it. So when we subtract 3,000 from 6, we still have 3,000 left in the bucket. But if we have no other assets in the bucket, our bucket has $3,000, but nothing to amortize. That's called a terminal loss. That's recognizing that our CCA calculation didn't take away enough value. So we need to subtract to make up the difference. So terminal loss, recapture, and capital gains affect dispositions of depreciable properties. There is no capital loss for depreciable properties because any reduction of value is considered to be amortization or a use of value. So we don't have capital loss for depreciable properties. Capital loss is only non-depreciable properties like corporate shares and land. So when we have a loss related to a sale of a depreciable property, that is terminal loss. And terminal loss is, I'm going to say, it functions like CCA. It's CCA that should have been taken to properly reflect the value. So terminal loss gets subtracted from income 100%. Recapture gets added to income 100%. Okay, now I understand that talking through this transaction might have been confusing. I try to do it this way so it's kind of all wrapped up in one explanation. But if you found it confusing, don't worry. We'll go through the slides, and hopefully by slowing it down, it makes it more understanding. Let me share my screen, so we'll go through the slides. Dealing with a disposition most commonly occurs when we sell an asset from one of our buckets, from one of our classes. So we sell an asset, we have to consider its effect for gains, for capital gains, recapture, terminal loss. But it's not only sales that can occur. This happens whenever there's actual or deemed dispositions. Let's say I have a machine in one of my classes and the machine broke or caught on fire. And in one way, it was just destroyed. If the property was destroyed, it's considered disposed of we just have proceeds of zero. No one gave us any cash, but we are out the machine. So we would deem a sale just using $0 of proceeds. This also applies if the property was stolen, foreclosed, or repossessed. If someone takes something of ours and we get nothing in return, it's deemed disposed of at $0. This is so if someone steals a machine and we're not going to get it back, we don't want it to sit on our books. We want to recognize that reduction in value, that lost value, and then we would just consider the proceeds to be $0 because we didn't get anything. Anytime an individual passes away, all of the property they own is deemed sold at death. So we will recognize any changes in value between when they paid for it, when they died, that change in value gets recognized, and then whoever takes over the asset will only follow their value change from the point of death. So we're recognizing change in value during someone's life. If someone severs their residency with Canada, we also recognize that change. It's deemed sold when residency breaks, so that Canada can still recognize and potentially tax any change in value. If we change in use from personal to income producing, let's say I buy a house. Let's say I buy a house for $500,000. I live in it a number of years. Perhaps its value's gone down. So when I start a business, I start renting it to move it over at that value and then start taking CCA might not properly reflect the amount of usage related to business. I have to identify the change in value while it was mine, while I personally used it, and then that new value will transfer to the business. So we have these deemed dispositions. I either got rid of something, I lost something, something was taken from me. We don't have it anymore, it's sold, or disposed of. If I die or I leave the country or I'm changing its function, these are changes in use or status where we have to recognize its value at a given date. So it will be deemed disposed so we can do those calculations. Anyway, so we have the concept of recapture and terminal loss from a disposition. If we sell something for its UCC amount, there's no tax consequences. We bought something for 10,000 by taking CCA and our U of 4,000, our UCC is now 6. So our records are kind of saying this thing is now worth $6,000. So if we sell it for $6,000, we got exactly what its value was. We didn't have any return, we didn't have any losses. So if a Class 8 property with a capital cost of $100, let's say over the years we took CCA of $70, so the remaining UCC is 30. If we sell that property for $30, we are giving up $30 and we're getting $30. There's no profitable exchange. So there's no tax consequences. The remaining $30 will be subtracted from our UCC value, getting it to zero, and then there's nothing that needs to be done. But what if we sell it for above our UCC? If we sell it above UCC, but below capital cost, we have to recognize the amount of CCA of amortization we are recovering. Class 8 property cost 100. The CCA taken over the years was $70, so $30 remains in the UCC in our bucket. We sold the property for for $55. That's $25 more than our 30. So over the years, we deducted $70 from our income through CCA, but we got back some of it. We got the $30 that the UCC said was still there, plus we got $25. So that $55 total we have to recognize. So 70 of the $100 was written off as CCA, but we only needed to write off 45. A $45 deduction in our UCC would have properly reflected the change in value over those years. $55 of the original capital cost was recovered through disposition. So that extra CCA, that $25 of extra CCA we took, $100 minus 70 minus 55, represents an add back of value. So that add back of value is recapture that gets recognized in business income in the year of sale. Let's say we didn't sell it above UCC, but below. So our capital cost was 100, CCA 70, remaining UCC 30. Those are consistent. But now we only sold it for 10. So when we sell it for 10, that $30 will subtract our proceeds, leaving $20 in the bucket. But the asset's not there anymore. So we have $20 of UCC, but nothing to amortize. So we have to recognize that loss in value, that loss in CCA that we should have taken to recognize that the value was dropping more. So we needed $90 of CCA to properly recognize the decline in value. I want to emphasize we're not wrong for having taken $70. $70 of CCA might have been the result of our calculations, that CCA required calculation. But those CCA calculations don't always reflect what's happening in the real world. So our calculation says we could deduct 70. The real world says this asset lost $90 of value. So we need to recognize that further decline. Our bucket after our sale has $20 left in it and nothing left to amortize. So that $20 shortfall is considered quasi CCA, better known as terminal loss. Now, the thing about terminal loss is we only recognize it if there's nothing left in the class. Because classes can hold lots of assets, I mentioned desks and chairs and couches. If we have other assets, then that remaining balance of UCC could be argued that it just relates to the other things that are in the class, the other things that are in the bucket. But once the bucket is empty and we have UCC left, then there's no argument. Clearly, we have a reduction of value that was never recognized. So the total write-off will be $70 from capital cost plus $20 from terminal loss. That recognizes the $90 of value decline, and we got back the $10 proceeds of sale. So these things add back up to our original capital cost of $100. Last example. Oh, no, there's one more. So sale, I think that might just continue on with this. Class 8 property with a capital cost of $100, CCA of 70, means our remaining UCC of $30, but we sold it for 110. So we've been recognizing a decline in value that clearly didn't occur because the value of that property actually went up. So $70 of the $100 was written off at CCA, but we need to recover all of that reduced value, all of that expense CCA, as recapture, and the difference above our cost will be the capital gain. So theoretically, no CCA was actually needed to recognize a decline in value. So we will fully recapture the CCA. $70 will be included in our business income because over the years, $70 would have been subtracted from income. So we get that income back. Property sold for more than its capital cost. So we have $10 of gain, 110 minus our $100 original cost. That $10 of gain will be included in income at $5, only 50%. So if it was purchased for the first time in 2025 for $100, property was damaged in 2025 and sold for 10. So we bought it for $100, but it got damaged and we disposed of it in the same year. Since we haven't gotten to the end of the year, CCA has not yet been taken. On sale, UCC decreases from 100 to $90. So that's 100 minus 10. That's what we sold it for. So we lost $90 of value in that first year. So $90 is the terminal loss, which is fully deductible in year of disposition. So if we add that $90 of terminal loss plus the $10 we got on our proceeds, that adds back to our original cost. Please remember, Depreciable property does not have capital losses associated with it. We either have gains or recapture and terminal losses, which is sort of correcting that difference between CCA, or accumulated CCA, and what we actually sold it for. Okay. We're at 20 minutes. I'm going to stop there. This video was our explanation of disposals. If it was confusing, please watch the next video where we will actually do the calculations. It might be clearer once you actually see this math at work. Thank you for your time. See you in the next video.